Good morning, everyone. Thanks for joining me today for our webinar on cash flow, cash flow made easy. My name is Kristy Bailey. I'm a presenter and an advisor for Business Station as part of the Digital Solutions program. Just a quick disclaimer, I am not a bookkeeper, so any advice that I'm giving you today is really based on my experience from the operational side of running a business. Do keep that in mind. So a lot of the tips that we go through will be more practical. The webinar is designed to be as interactive as possible. So use that Q&A functionality or the chat functionality and ask any questions. Please feel free to stop me as we go. But just keep in mind, I will also stay on the line for a couple of minutes at the end of the session to answer any questions as well. Okay, so what we're going to cover today, well, throughout the webinar, you're going to gain an insight into the cash flow process and how you can best manage it. Now, you might already be looking at cash flow and forecasting cash flow, and therefore you sort of understand the overall process, or perhaps you haven't looked at any cash flow whatsoever. So we're going to go into depth on that. We'll look at what the relationship is between profit and loss and cash flow. We'll obviously discuss what cash flow actually is and why it's important to you. We'll look at how you can develop more of an analytical approach to cash management and effectively track your performance. And then finally, we'll look at strategies to stretch your cash flow further as well. Okay, so what is cash flow? Well, cash flow is a term that's really used to describe the amount of cash in actual dollars that's generated or consumed in a given period of time. So cash flow has a lot of uses, both in operating your business, but also in performing more of a financial analysis of how your business is going. I think that it is one of the most important metrics of all finance, or accounting for that matter, because it really is the lifeblood of your company. Understanding your cash flow will allow you to evaluate that flow of cash or the flow of funds in and out of your business. And forecasting will mean that you're able to identify when and where there are potential problems, so you'll really see what could be causing the problem. So in my opinion, understanding cash flow is a key element, and it is the key to your business success. Once you find out how to manage it and you've got some mechanisms in place to effectively manage it, then you can look at how you can stretch your cash even further. Now, cash flow versus profitability, there's always a question around this, but profitability tends to be the ultimate goal when it comes to the financial side of running a business, but you don't generally determine true profitability until the end of a period of time. So most people look at a P&L at the end of a month, perhaps the end of a quarter, or even the end of a financial year. So that's really the key difference between cash flow and profit. Profit looks backwards, whereas cash flow looks forwards. Profit indicates the amount of money that you're going to have left after you've paid all of your expenses. So all bills are paid and all incomes received. So that's why it's normally end of a financial year that from an accounting perspective, that assessment will be made on, was the business profitable? Making that profit in really simple terms means that you've made enough sales of your product or service to cover all of your existing costs, which are your expenses, and hopefully you've got a bit extra, or a little bit to spare. Cash flow, on the other hand, indicates that net flow of cash that comes into and out of a business at any particular time. Now, depending on how you want to structure your reporting, it could be outlined in weeks, it could be outlined in months, or even years, depending on what your preference is and how you want to manage it. The most common, and one of the examples I'll show you, is actually a monthly analysis. Now, throughout the webinar today, you'll discover why cash flow matters so much, but it absolutely does matter, and it matters a lot. Having good or positive cash flow means that you're going to have enough money to pay all of those expected expenses, and you'll be able to pay them when they're due. You'll know when you're able to reinvest in the business or potentially purchase capital or any other assets that you might need to grow your business or even to run it more efficiently. You'll see when it's appropriate to take money out for yourself or to return money to shareholders if there are shareholders within your business, rather than just taking bits and pieces as you go and really not knowing if it's appropriate to do so. The other thing about cash flow and why it matters so much is that you'll have that assurance that you've got a buffer to cover you against any future financial challenges. Now, those challenges could be unexpected equipment replacement, they could be legal expenses, there could be absolutely anything that is unforeseen. Things do pop up, and you need to know that you can cover them. Now, if you have cash flow problems, that means that you don't have enough money in the bank for those necessary things that are planned, let alone anything unexpected that might pop up. So you have to keep in mind as well that when you're looking at cash flow, you can have profitability. So you can be a profitable business, but still have cash flow problems throughout the year. Now, this happens if you've got, let's say you work with clients that are on invoice and they pay late. However, you've got early paying terms to your suppliers. So there's a gap in when you're putting the money out and when you're receiving it. It can happen due to that. It can also happen because of seasonality. So you might have a low season or a period that you're not able to operate, and the high season or the busier time provides you the cash to get through the low time. So you need to know that at that time, it's not just great, I've got extra cash in the bank, let's spend it. You will have to put it aside to get you through those more difficult times or the lower seasonality. Now, figuring out your cash cycle and the payment terms around that is one of the very first things that you can do to be cash flow positive. So we'll have a look at that. Now, in terms of your cash flow, if you're in an existing business, it is really important to continually analyze your cash flow. It's not something you're just going to do once and go, yeah, that looks good, I'll keep operating. I would be looking at this every month, comparing your actuals against what you budgeted for or what you forecast as well. It's pretty straightforward when you're an established business because you've got a record of expenses and that kind of thing. So you know what, on average you would bring in by way of income and on average what would go out by way of expenses. However, if you're a startup, the first goal is going to be to maintain a positive cash flow. And then once that's under control, you'll be able to, I guess, make it as profitable as possible. So try to get more money through the business and keep those expenses down. So also straightforward, but it's really, there's a few more unknowns when it comes to a startup. All right, so tracking your cash flow is absolutely crucial. It will allow you to operate profitably and generate positive cash flow. Or if you can see that there are periods where you're not operating profitably, you'll have to make some necessary changes to improve that cash flow. For example, you might identify that you need to reduce certain expenses because they're increasing, they're not necessary, or whatever that might be. Or you might need to increase revenue in particular areas or at particular times of year. And therefore, you're going to have to take steps and find ways to be able to do that. So that will, the tracking of it or the mapping of it will allow you to look at what's working well and what's not working at all and make those relevant changes. You can set the budgets based on what you know you need to achieve at certain times. And then, like I said, check it every year to make sure that you're meeting that budget. That allows you to be sure that you have enough cash. Or you might have to find ways to get input. So that might mean that personally you need to input some funds. It may mean that you need to look at getting investors on board, or it might mean that you need to look at even selling assets to be able to inject some cash into the business. All of those things take time. So it's really important that you do have it planned so that you can take the time to find the additional cash. It also allows you to make really informed decisions on many areas of your business, but that could be anything from purchasing to staffing to, sales and generating more sales, to leasing versus purchasing equipment, how much space you're going to rent, all of those things. So it really just gives you the backing to make a strong and informed decision on your business and to know that financially that decision will be supported. And with all of that knowledge, it means also that you'll be able to reach your business goals. Okay, so creating a forecast is absolutely crucial. Now, because cash flow matters so much, obviously you should be doing everything in your power to increase it. And that's where forecasting comes into it. So it'll allow you to know exactly when you've got inflows and outflows and really just map everything out. Now, there's a lot of different templates available online. I find that some of the best are on the Australian government website, so business.gov.au. Banks also offer a range of templates, and they're generally downloadable and normally in an Excel format, and they're free as well. So I will show you an example in just a minute, but do find a template that you understand and that works for you. Templates, as I mentioned, they're normally in an Excel format with preloaded formulas. So you're just popping in figures and it's calculating that monthly and then annual cash flow as well. Now, once you've got your template, to get started, the first thing you need to do is to decide the period that the forecast should cover. You'll add in all the cash inflows and then deduct the cash outflows for each period. Now, it's usually by month, and that's the example that I'll show you will be by month. You might find it more relevant in your business to make it by week. I wouldn't look at anything more than that. I think by month at a bare minimum allows you to see what's going on. Now, if you've got an existing business, and I did touch on this earlier, but the best way to start that process is to get all of your data from previous years and input it into your forecast. So pull all of your accounting reports, all of your expenses reports, month on month, pop them into the schedule. As you're putting them in, you might identify that adjustments need to be made based on past trends. You might know that some of your expenses are decreasing, or some of them were one-off expenses for a particular reason, so they might not reoccur in the next financial year. In terms of the inflows, I would again look at past trends around sales. You might again make assumptions and adjustments going, well, that last year, February was really low because we had lockdowns for however long within the month. So you might anticipate that next February is not going to be the same. So you're going to make an assumption around being open and available for that whole month. So that's really straightforward. When you've got an existing business, it's really just mapping out and having a look at what you've sort of achieved in the past and just deciding if that's relevant or making some assumptions around going forward. Now, if you're a new business, when you prepare your cash flow forecast, you will start by estimating all the cash outflows. So you'll have to do some research around that. You'll have to get quotes from insurance companies, understand what loan repayments will be. All of those things will have to be input into there. Some of them you'll have to make assumptions, but most of them you should get firm costs and do your research to get that right. Once you've determined all of your outflows, that will give you an idea of how much cash needs to come in to cover at the bare minimum the outflows, and that should tell you your bare minimum sales that you need to achieve month on month. Obviously, the more sales, if the expenses stay the same, then you're going to be making a good profit, and that's generally the ultimate goal. Now, do keep in mind that sales figures will always change because of factors like I mentioned, lockdowns. They could also change based on the type of customers that you sell to, how quickly those customers have to pay you, what the economy is doing, by way of interest rates or unemployment rates. Also, what your competitors do can really impact on your sales as well. So my advice in terms of creating a cash flow, particularly with the sales element, or in terms of creating a cash flow forecast, I should say, is be realistic when you're forecasting. Make sure that you are as realistic as possible, because at the end of the day, if you're not meeting the sales that you anticipated, you're going to have a lot of work to do to catch up. So I would be as realistic as you can, both with sales and expenses, but expenses tend to be a known factor, whereas sales will fluctuate based on a lot of external factors. Okay, so we'll look at this template as a starting point. Like I said, there are a range of different templates available online. So find one that you like. I personally like this one. And this is from the Australian government website, but there are tons available. So generally speaking, and I'll show you on the screen, they'll have your cash incoming. So this top section here is all about cash incoming. And this bottom section here is all about cash outgoing. So in the incoming, you'll think and include things like your sales, Do you plan on selling any assets? So that might not be something that you sell every month, but there might be, you're going to sell a vehicle in December, for example. You might have debtor receipts that come in separate to sales. So you might have cash sales that come in July, but you might have invoiced for sales in July, but that the debtor isn't due to pay you until August. So therefore, this is about the timing and the flow of cash. So if you're not receiving the money until August, it would go in the August section. You might be planning on getting a loan, so you can input an injection of cash there, or any other income that you might be receiving. Now, you will always have an opening balance. Now, your opening balance, because this is a cash flow, it looks at the actual cash on hand. So let's say you've got $5,000 in the bank, you put that opening balance there. It will then add your 5,000 to anything you've said here. So it'll be 5,000 plus, let's say, another 5,000. So this will say 10,000. Sorry, this won't say 10,000. This will be 5,000. This will be 5,000, but it will be adding them together. Then you take off all of the outgoings, so any expenses, and you can see the various categories that they've got preloaded in here, but you might have other areas that are relevant to you. So purchases of stock, there could be accountant fees, solicitor fees, all of your advertising and marketing spend, bank fees and charges. You might have interest that you're paying, credit card fees, there's all of your utilities, telephones, loan repayments, rates, rent, vehicle expenses, repairs and maintenance, stationery and printing. So there's absolutely anything and everything that's related to the business should go in this section. So you have the $5,000 that you started with, plus you've made $5,000 in sales. Let's say you've got another few $1,000s there in expenses. It's going to total this up in two ways. One, it's going to give you a monthly cash balance. Now, your monthly cash balance is simply your cash incoming less expenses. So this is $5,000, take $3,000. So this will be $2,000. Whereas your running total here that you see down the bottom is actually going to factor in what you had in the bank to start with. So it'll add your 5,000 plus your 5,000 less your 3,000. So this would say 2,000, this would say 7,000. And then that would roll over into your August because you've now got that extra cash in the bank. And so on and so forth. So you'll have, I think it's really important to look at this in two ways. Firstly, it's really important to look at this monthly cash balance. There might be some months where you're in the negative and you might say, all right, November isn't looking very good at all. What are we going to do about November? If there's nothing you can do about it, if it's typically a quieter month for whatever reason, you might find that you do take a hit in November, but you need to know that the cash that you've got rolling over from the other months is enough to actually cover November, if that makes sense. You don't want to be taking, thinking, wow, that October was good, I'm going to take all the money out, only to find later that November is typically a quieter month and you actually need cash in there to cover your expenses for that month. So that's kind of the huge part about a cash flow, and forecasting your cash flow is absolutely crucial so that you can really look at this stuff. In terms of your outflows, just one thing, obviously you've got wages and expenses, PAYG associated with that. You've got superannuation associated with that. Don't forget them, absolutely incorporate them. They do have to be paid. I find a lot of small businesses do let these sort of add up a little bit, but map them out when you need to pay them. If it's monthly, make sure that they're accounted for monthly. If it's quarterly, pop that on the cash flow forecast as well. So keep that in mind. Or any government liabilities, whether it be the taxes, super, whatever that might be, they're known, so don't forget them. So don't just pretend that they don't exist, because they do. And don't forget your accounting fees as well, which might be annual to do your overall accounting, and then you might have bookkeeping fees that go on month to month. So that's pretty straightforward. If you do have any questions around this cash flow forecast, let me know. Another thing that's important to note here is with your sales, you're going to put a figure in here, but you'll have to do some work on some assumptions. I normally do that in another document where you've got a sales assumption calculator, so that you know how did you get to that figure. You can't just say 10 grand or 5 grand, pop it in there. you have to do a little bit more around how many units of your product or service does that mean you're going to sell? What's your capability? You know, how many can you sell? What's your maximum capability? So you really have to look at some sales forecasting that sits away from this document, and then you'll just simply input that final figure into here. All right, so that's kind of the tracking, the importance of tracking, and actually how to track. Now we're going to get into the good part, which is obviously once you've mapped out your cash flow, you're all set up to track it. You may identify if you need to improve it or areas that you absolutely have to improve it. But do keep in mind, whether there's a profit or a loss showing on your cash flow statement, you still should look at ways to improve it, because that's going to result in extra profit for you, additional profit essentially. So strategies for improving your cash flow fall into one of three categories. You've got revenue growth, you've got operating margins, and capital efficiency. So of this, as you can see mapped out on your screen, there's an extensive array of areas that you can improve your cash flow. We're only going to look at some of the key areas within these three main pillars. Depending on the nature and the industry that you're in and your style of business, it's definitely worth considering all areas of your cash flow, but only looking at what's relevant to your business. Now, another thing I'll add, my background is marketing. So a lot of what we're going to be talking about here really does come down to marketing or strategic marketing. But first, you have to understand your position to be able to improve your marketing, and that will subsequently improve your cash flow. So to expand on these three main pillars, you've got revenue growth. Now, this is a couple of areas. You've got your volume of goods and services sold, or the price of what you're actually selling it for. You've got your operating margins. Now here you're looking at your COGS, or your cost of goods sold, and then you're also looking at your selling, general and administrative expenses as well. Capital efficiency. Capital efficiency is pretty straightforward. That's really just a question of how efficiently you're using your cash to operate and using it to grow as well. And then you've got your property, plant and equipment that sits under capital efficiency, and your inventory. So two sort of elements to that. So as I mentioned, we're not going to go into absolutely everything that you see in some of those subtables on the screen, but we are going to go into the key areas that generally tend to be relevant to everybody. We'll start with pricing. So I deal with a lot of small businesses, and one of the things that I always like to discuss when I first start working with them is about their pricing. How do they set it? How do they know if it's right? Does your pricing cover costs? What products or services are more profitable or do better than others? Now, a lot of businesses can't answer that. So thinking about your business, do you know what are your most or your least profitable products and services? Do you know how you can increase those products that are more profitable and decrease the less profitable products to allow you more time or to allow you to sell more of your more profitable products? And then thinking of them all, how much time is invested in each of them? When you set your pricing, how have you set your pricing? There's a couple of different pricing strategies. Some people will set their pricing on cost plus, which is what it costs you plus a percentage markup. You also have to consider what your competition is selling the same product or service for as well. You don't necessarily need to be cheaper than your competitor, but you need to understand what your competitors are charging. Are you looking at that and setting your prices based on that? Or the third element of pricing is what the customer is willing to pay. So you can't look at any of those three elements in isolation. You really have to look at them all. So you have to know what it costs you, and you have to have a decent percentage markup on that. But you have to know that you're competitive, or if you're not competitive, if you're charging more than your competitors, you have to know that your value is higher than your competitors, or your customers need to know that. And then you also have to know what the customer is willing to pay, because sometimes there's a tipping point for customers where they're comfortable at a certain level, you nudge it a little bit higher and they're just not comfortable, so you'll notice a drop in sales. So you do have to look at all three of those elements and be continually tweaking them to be effective. You have to know what it costs you have to be competitive, and you have to know that the customers will want what you've got. And ultimately, you have to make a profit as well. Now, this does go back to a marketing strategy. What is it about your product or service that's unique or different? What sets you aside from your competitors? Can you perhaps charge more because of that, regardless of what your competitors are doing? Or do you want to base your pricing on more volume, less profit? Now, when it comes to pricing, an interesting thing with regards to discounting is that discounting equates to more work to maintain a margin, whereas increasing your price is less work and fewer customers to maintain a margin. So you've really got to consider how that fits with your business model as well. Now, if you increase your price, you might lose a certain type of customer or a market. But on the flip side of that, if you decrease the price, you can attract the wrong market. Now, I've seen that before with bulk buying website deals. There's Groupon, Scoopon, those kind of things where you're selling your product or service at an extremely discounted price. You're selling lots of whatever that product or service is, so the volume's there, but you're selling it, like I said, very, very discounted. And the type of customer that's buying it doesn't tend to be a loyal customer. They tend to be the type that are looking for deals, shopping around. So you might find that rather than getting repeat purchases that you would normally get through your more higher value customers or your full price customers, you're getting these one-off transactions where they're either difficult to please or they don't have that loyalty, so you don't see repeat business. So it costs about 8 times more to attract a new customer than it does to retain an existing customer. So if you're getting a lot of new customers in at a really discounted price and you're not able to maintain them, it's really not an overly effective strategy in terms of pricing and your business model. So really think about that. Think about volumes and the price and the association between the two. Now, just expanding on volume, thinking about that, can you increase your volume overall and specifically the volume of more profitable products and services? Perhaps there's new markets to sell to. Can you create new products? Could you improve your sales processes to allow you to produce more? Now, there is a profit enhancement model, and to determine what sort of profit enhancement you're going to be looking at, you would look at a few different options. Now, these are outlined in the table that you see here. First of all, in the blue, you've got market penetration. That's where you've got existing products and an existing market. So this is when a company penetrates a market, and in that market, there's current or similar products that already exist. So essentially, you're gaining your competitors' customers. The next element in the green is product development. Now, that's developing new products for existing markets. So thinking about that, can you launch a new product or service? Maybe through what you've identified in researching your competitors, or you might have identified an emerging trend or something like that. You can come up with some kind of new product or service. In the orange, you've got market development. Now, this is existing products that you're selling to a new market. So you're developing new markets for products that you've already got. Now, this could be broadening your scope. For example, you might look at attracting the international market when you currently have a majority of a local market. We saw a lot of market development when COVID hit, and shops, for example, suddenly went into lockdown. So they were very much, bricks and mortar going online and really opening themselves up to completely new markets, but their same existing products. Then the fourth element of profit enhancement in red there is diversification. Now, this is new markets, new products. So thinking about that, can you spread into completely new areas or sell something different to your existing core product? Now, there's challenges when it comes to diversification in terms of branding, making sure that that makes sense with your overall brand, or perhaps even creating a new brand, and therefore it's almost like a new business. You have to think about the time, the costs, and the overall expense in terms of getting a new product to a new market. Like I said, it is similar to a startup in that it will be a lot more expensive to do that. So diversification can work really well, providing you've got the research and you've got the backing behind that. So in terms of volume, other than these profit enhancement strategies, I would look at how else you can increase your volume. Thinking about sales processes, could better processes allow you to sell more? And this is where, you identify any bottlenecks in the process. Now, this could be a machinery bottleneck, and, through your cash flow, you've identified that you have a bit of cash at a particular time. So you're going to upgrade a piece of equipment that's actually going to really improve your sales processes and allow you to produce and therefore sell more. So those kind of things, what you can assess once you've mapped out your cash flow as well. I'd be looking at increasing advertising. Obviously, that has a spend attached to it, but the more promotion, the more advertising you get, generally speaking, the more business you should get if it's done right and if it's targeted. Obviously, salespeople are important as well. If you've got salespeople, ask yourself if they're good. If yes, they are good, make sure that you've got a good plan in place to retain them. If you need better salespeople, make sure that you've got a good plan in place to attract them. Now, we will get into staffing and talk a little bit more about that. But what the analysis part of this is looking at what's a quick win on a cash flow as a cheaper staff member may actually limit your sale ability. So we'll have a look at that and have a chat about that. Also, as I mentioned, repeat customers are a really key area of or potential area of growth in terms of selling more. The stat that I said earlier was that it costs about 8 times more to attract a new customer than it does to retain an existing. So look at some kind of customer rewards program to increase volume and to keep people coming back. Some kind of incentive to keep people loyal to you. All right, the next area to really improve your cash flow sits with your debtors. Now, a pretty interesting ATO statistic is that small businesses in Australia are owed $26 billion at any one time due to debtors. So you really need to address any issues with debtors. I'm constantly surprised at the payment times and terms on invoices that I receive. So I would really encourage you to collect payments as quickly as possible. You might even want to look at a discount for prompt payment. Some businesses look at introducing late payment fees to avoid those late payments. You might find as a small business that's not really appropriate to you. It might not suit your business model and your customers, but have a look at what is most suitable to you. Invoicing earlier is another sort of easy avenue to address. Some businesses will allow their customers to transact with them throughout the month, and then they'll issue an invoice at the end of the month that then has another month payment term. So it could be almost 60 days between a transaction and actually receiving payment. So I would encourage to send invoices straight away if you can. I had a really good example of this yesterday. In my other business that I run, I had some staff that were going into a particular store for some maintenance equipment, and they went in there 3 times yesterday, and each time they went in, I literally got an invoice. So they weren't even waiting to the end of the day to invoice our business. It was boom, boom, boom. And I said to the guys, oh, how can you keep going back? And they kept forgetting things. But yeah, they were very, very switched on in terms of their invoicing. So that's an interesting concept as well. Maybe that doesn't suit your business, and maybe that adds actually more workload. But you could consider invoicing mid-month, for example, and at the end of the month. So if you do have customers that come back a lot, you might have a 15th of the month invoice cycle and then a 30th of the month invoice cycle. So you're getting the payments at 2 intervals. Switching from paper to electronic invoicing is obviously hugely advantageous. If you're using some good software, that software should be able to electronically email invoices, obviously, but also offer follow-up services. So you don't even have to actually touch that or follow it up. You might set up a schedule so that if a payment's, 2 days before it's due, a reminder sent out to say that it's coming up. It might be a week after payment's due, you start sending payment follow-ups or whatever that is. But definitely look at software that has follow-up services. Now, electronic invoices are a lot more professional than paper. They're obviously easier to send, they're easier to store, they reduce turnaround times. So do consider that. And follow up payments promptly if they're not paid on time. Again, go automated so that you don't have a staff member that's responsible for doing that. The more automated the payment follow up is, the quicker that you'll get paid and the less time you'll have to input to actually get the payments. Now, there is also e-invoicing. So you may have heard about that. That's electronic invoicing. Electronic invoicing or e-invoicing is an automated digital exchange of information directly between a buyer and a supplier's accounting system. Now, with the introduction of e-invoicing, you won't need to generate PDF or paper invoices. Once the two companies are connected to the same e-invoicing network, you can start using accounting software like Xero to send and receive invoices. So the government, if you're a supplier to government, they're actually moving on to e-invoicing. Now, the ATO says that it can cost over $30 to process a paper or a PDF invoice, compared to less than $10 for e-invoicing. So keep that in mind. That's a good stat as well and something to keep an eye out for. I did touch on this, but reduce your terms, make it shorter than 30 days or whatever your payment terms are. If you're issuing an invoice, there's no reason that that shouldn't be paid within 7 days, for example. So have a look at that to just reduce that amount of time that you're out of pocket. I would also highly recommend making paying easy. So if you can offer multiple payment methods to your customer so that they can pay when it suits them, it's going to be a lot more effective. Now, this could be credit card as well as direct deposit. You might allow them to set up direct debit so they don't even have to think about actually paying an invoice. They're just on a cycle where it's directly debited from their account. So again, you have to know what's most suitable to your business, what's most relevant to your business, and work within that. But debtors are a major area. Like I said, $26 billion is owed to small business at any one time. Make sure that you get yours. All right, assets. Assets are pretty straightforward. I would simply look at if you can free up some cash by selling underused or unused assets. So businesses tend to accumulate assets that at some point they don't require anymore. So if you can sell unnecessary assets, you can increase cash in the business. You might save on costs like insurance and storage and those kind of costs that come with holding assets that you're not using. You might want to look at leasing to free up cash. Think about leasing and whether it works out better for you. If you remove the cost of maintenance, you may remove the risk of complete failure requiring replacement. So the other thing about leasing is that it smooths out cash flow. So rather than, having a bulk purchase of an asset, you might just have a monthly amount. So if it's appropriate for your business, it can be a really good way to free up some cash. The other thing that you can do with regards to your assets is look at refinancing or negotiating better terms with any existing loans or bank agreements that you might have. Review those, see what they are, and see how you can improve them to even just to get your repayments down, perhaps. All right, expenses. Now, put very simply, expenses decrease the amount of cash that's going to be available to your business. So I would always be looking at what you can do to reduce expenses. Can you defer expenses, or could you ask for better payment terms on certain expenses? Could you rent a cheaper location or negotiate a better deal with your current lease? Are there any cheaper alternatives to any of your expenses listed? Now, I would literally go through your expenses item by item and say, is this the best possible deal? Am I using the best possible supplier? So there could be new plans or technology packages. There could be expenses that are just ongoing and you realize you don't actually really need them anymore, so you can remove them entirely. I would have a look at reviewing things like insurances and just review absolutely everything to try and negotiate better deals. I would also, and I'm going to touch on staffing a little bit more, but look at the comparison between outsourcing versus in-house staffing. Now, it can be really effective for specialist roles or particular tasks in your business. The most common that you see in terms of outsourcing would be things like bookkeeping, particularly with more automation. You might have less demand for an in-house bookkeeper, marketing, and some other administrative roles, even HR and those kind of things can be great outsourced. It doesn't suit every business. You have to understand your business and how it best operates, but absolutely look at the alternatives behind that. Then we've got inventory. Now, inventory may not be relevant to everyone depending on the type of business you have, but if you do have inventory within your business, it represents cash. So if you're holding it for more than 90 days, for example, it's going to cost you significantly. So in terms of your inventory, there's a few elements that you can consider here. The first is look at if you can source cheaper stock or materials. Always review your pricing from suppliers and do that regularly. Now, that doesn't mean that you have to change suppliers. You might have suppliers that you're very happy working with. However, it is always good to get even an annual comparison quote just to see if their pricing is remaining competitive. You could always, you've got a favorite supplier, you love dealing with them, you get a quote from someone else, the quote comes in cheaper. You can go back to your original supplier and say, look, we've got a great relationship, want to keep working with you, but I can get the same product or service cheaper through someone else. Are you happy to match that price? Chances are they will be competitive and try and bring it down or match it, or they'll be honest with you and let you know that they can't, and then you're going to have to make that business decision as to, do you maintain your relationship or do you look at your cash flow? Purchase power is another element. You have buying power when you understand your own cycle. So once you've mapped out how much cash you have at certain times versus how much stock you use, you can see if there's any efficiencies there. There might be times of year where you've got excess cash and you know how much stock you're going to use over a particular year or quarter. So you would be able to perhaps buy in bulk and therefore get a discounted rate. But in saying that, with your stock, make sure that you're always maintaining the right levels. You don't want your stock to be too high that it's cash, essentially, it represents cash. But you also don't ever want to run out. So really track the movement of your stock, have processes in place to identify when new stock should be ordered. You can try and return anything that's unsold, but in that sense, you have to know your suppliers' return policies. And I do know that so many suppliers have really tightened those return policies since COVID, because they had all small businesses trying to return stock and get their cash back, free up the cash. So suppliers were very left in a difficult situation as well. So that may not be a possibility anymore. So if you can't return any unused stock, you have to think about how you can move it faster. So you might have a physical store, you might want to put some products online to get them moving faster, or vice versa. You might be online, you might want to do pop-up stores or something to just shift this unsold stock. If you can, use a software platform to manage it. Otherwise, you might want to do it manually. But any way that you can replace slow-moving and obsolete stock with stock that has a faster turnover is going to really help your cash flow. You do have to know what sells well and what doesn't. Now, Jan has just asked if you get a copy of this webinar, and you absolutely will. So a recording will be sent to you at the end of this session. The other thing you can consider with regards to stock is drop shipping or just-in-time stock orders. You might be able to find suppliers who'll provide you with stock that's only when you need it. So that way you're not wasting money paying for stock that's sitting in a warehouse or a storeroom. So drop shipping can be good. You only order once you've had an order from your customers. Couple of things with that. You have to make sure there's no delay on delivery, and you have to really trust the company that is offering this dropship service. I have heard some horror stories about incorrect products being delivered to people and those kind of things. So just really make sure, do your quality assurance check in that sense as well. In terms of your supplier terms, your payment terms, make full use of your terms of trade, because that equates to an interest-free loan. So don't pay early. If you can extend your supplier terms, they might have 7 days, try and make it 30. So opposite to what I've said to you about reducing your terms, try and go for a supplier that has longer terms, because it is an interest-free loan for you. just had another question with regards to the slide deck that will be sent to you as the webinar recording. So whatever you're seeing on the screen now will be sent to you. So essentially, yes, but you won't get it as a PDF or as a PowerPoint, if that makes sense. Okay, staffing is the next element that we're going to talk about. Now, I've touched on a couple of things here, but when it comes to staffing, staffing is a key area that can become a major expense for business. Now, in terms of staff management, firstly, rostering to cover demand to produce revenue is obviously very, very necessary, but you've got to have that fine line and not overstaff. Try and match the roster system to your peak periods, or have flexible staffing arrangements in place so that they can do things like split shifts or just really maximize the time that they're working with when revenue is being produced. You might want to consider outsourcing, like we touched on, particularly for specialist roles, so that you're only paying on demand rather than having a full-time employee in those roles. The flexibility of workers in terms of within their own role is really important as well. Can they have multiple roles within a business, or are they able to multitask when needed? For example, if you've got a shop, but you've got someone out the back that perhaps is responsible for your marketing or accounts or whatever that might be, when the shop's busy, can they go out the front and help with that so that they're able to actually assist with that revenue incoming? And that really comes down to training and expectations. Some staff members would be out the back going, that's not my job. I'm a, the marketing person, or I'm the admin person. Whereas at the, that employment opportunity, when you employ them, you can say, this is who we are. We all get in and help out at times that are tough. So it's really having that attitude of flexibility around your workers as well, and multitasking. But aside from multitasking or having flexible workers, make sure that you've got maximum utilization of your staff. And you can do that through setting targets to really maximize productivity of each staff member. You might want to incentivize sales with commissions or reward staff behavior, even that improves cash flow. So it could be something like sales targets, or it could be a target for reducing expenditure as well. Sales targets are a great way to increase sales, but the other thing in terms of cash flow, you have to make sure that you're only paying commissions when you've received the payment, because otherwise, again, from a cash flow perspective, you're going to be out of pocket. So those commissions would only be paid after the customer's paid in full and that deal is done. Another tip is to look at the qualifications of your staff and really employ more qualified staff. So paying a staff member that's more qualified can really increase your sales and your customer satisfaction, and that will in turn increase positive word of mouth. It'll encourage repeat customers. So unqualified staff or lower qualified staff might look like a quick win on a cash flow forecast if you're looking at wages and that kind of thing, but in fact it can be really damaging to a business. So absolutely consider that. You see really good examples of this in the hospitality space. You might be at a restaurant, someone inexperienced is serving you. You ask them a couple of questions about the menu and they struggle to sort of answer. They don't have the personal experience to share with you, or they're not able to on-sell, upsell, those kind of things. And it really impacts how much you spend as an individual, but then how you feel about that transaction or about that experience once you've walked away. So think about that particular person, and could you pay someone $5 more an hour or $10 more an hour, and how much more would that generate in actual sales? So always look at that consideration as well. But when you find these good staff, retention is absolutely key. Reducing staff turnover should be a major goal of all businesses, because it has such a serious impact to the bottom line. Staff are expensive to hire, they're expensive to train, and you can absolutely avoid those costs by being the employer of choice. So once you've got those staff that are the perfect fit for your business, keep them. And things like incentives will really help with that. Obviously better communication, and there's a range of ways that you can really retain staff. And a lot of those ways actually increase their own productivity and their sales ability as well. All right, so that covers the different strategies to improve your cash flow. As you go through and complete your cash flow forecast, you can keep these strategies in mind. And then when you get to that point that you've determined if you have a profit or a loss, you'll need to make some considerations. So when it comes to profit, my recommendation is don't be too quick to take it out. Invest it back in to manage cash flow for future months or years. Use it to pay down debt, or see what you can do in terms of utilizing that cash, like we were talking about capital purchases to allow you to operate more efficiently and those kind of things. Now, if your forecast shows a loss, then you'll have to have a serious look at why that is. You may have to input your own money. You may have to get equity from investors. You might have to look at setting up a loan and borrowing to fill gaps. So you might want to speak to your bank about a loan situation. Overdrafts are a very common solution for cash flow fluctuations. Perhaps, it is your debtor terms that are creating cash flow issues. So an overdraft really solves that problem. Perhaps it's seasonal issues. So you've got a down season or a period that you don't operate, for example. So overdrafts are a really common solution to that. And a lot of times through a bank, you can get an overdraft that doesn't require much of an application process at all. There's almost like a pre-approved amount in some circumstances. So have a look at that. Now, the very final step and the most important step of all is just very simply to review your estimated cash flow against actuals. So you've taken the time to create this month-on-month forecast. At the end of every month, compare how that month did. Have a look at all your expenses. Were they on target and what you anticipated? Have a look at all your income. Was that on target and what you anticipated? Have a look and see, if not, why it didn't meet your expectation. Were the sales lower than forecast, or were the expenses higher than forecast? You'll have to then take different actions for different situations. The other thing I would really stress to keep in mind is you have to remember that your cash flow forecast or cash flow tracking is all about the flow of cash. So when you're preparing it, make sure that you're as accurate as possible on the timing of cash flows. So sales, for example, you might make sales in the month of July, but if you're not receiving payment because of debtors until August, those sales should be attributed to the August month. So really keep that in mind, because then it's going to be relevant and make sense when you look at the comparisons of actuals. All right, so in terms of mistakes, the biggest and most common mistakes that I see are running a business from your bank balance. This being the first, it doesn't account for planned or unplanned expenses, or perhaps the seasonal nature of your business if you've got high and low seasons. I speak to people all the time that do it, so it's absolutely not uncommon, but it is a big mistake in business. Improper management of taxes and government expenses is also another mistake. They're clear, they're known, plan for them. Now, this is GST, super, PAYG. There's penalties for late payments, and it is very simple to account for taxes, so do it in your planning stages. Spending too much money on sales is another common small business mistake. As a business, you do need new customers, but you've really got to understand the cost around acquiring those customers. Make sure you track your acquisition cost and track the total revenue each customer generates. So it has to be higher than the acquisition cost. You can't be spending more than you're earning to get them. So overspending in that area can lead to a small value customer with limited return. So keep that in mind. The more customers you have is not always the better, and it doesn't always mean that the higher the profit will be. You really have to look at what they're spending and what you're spending in terms of acquisition. Not forecasting is a big mistake for obvious reasons that we've spoken about today. Not collecting cash is fast enough is a problem. If your customers are delaying payments but your supplier terms are short, then you're the one that's acting as the bank in the middle. So you're giving the money out but waiting to receive it. So the other thing about collecting cash is unpaid invoices are cash flow killers. So late payments are bad, but invoices that aren't followed up are an absolute nightmare for small business. But what's worse than that, and I've come across this a couple of times, is when a supplier doesn't actually even raise an invoice. You would be surprised that companies actually do it, but for whatever reason, an invoice gets forgotten here and there. Now, me personally, I'm honest and let them know to invoice me, because I sort of think, oh, it's going to come back one day. Someone's going to ask for this. And I'd rather account for it in my cash flow when I anticipated it. But make sure your processes are strict enough and your procedures are strict enough that there is no way that an invoice can get missed, because it can be an absolute nightmare for a small business. Holding inventory for too long costs you money. We did discuss that, but inventory represents cash, so you don't want it sitting there, doing nothing for you. Taking too much cash out as a small business owner is also a big mistake. Now, you might take money out of your business sporadically, just take a bit here and there. You could think, yeah, the bank balance looks all right, I'll take a bit out now. It's obviously your right as a business owner to take money out of your own business. And you absolutely have to be earning money for the work that you're putting in, but account for it and plan for it and make it a structured part of your cash flow. Now, if you do suffer from negative cash flow, you can absolutely recover from it. You first have to find out what caused the issue. You'll have to change your payment terms, reduce operating costs, run promotions, and then obviously meet with a lender if all else fails. So that wraps up our session on cash flow. I do hope that it makes sense to you all, and I hope there's some things that you can take out of it to improve, or at the very least better understand the cash flow position in your business and understand it at any time of year. I'm going to stay on now and answer any questions, so please fire away with them just by Q&A or chat. But keep in mind, we really have scratched the surface. So if you want to know more or talk about any other aspect of your business, today's webinar is being presented to you as part of the Commonwealth Government's Digital Solutions Program. As part of that program, we have a range of more than 25 advisors with specialist experience in a range of different areas. For $44, you can get access to those advisors. You get 3 one-on-one sessions with an advisor, plus access to workshops and webinars. So do keep that in mind and look at signing up for that program if you haven't already. There's a bit of eligibility around that. You have to have an ABN in WA, Queensland or NT, be operating for profit, and employ fewer than 20 full-time staff. So that's it from me. Thank you so much for joining me today for our session on cash flow. I do hope it helps, and good luck with your cash flow forecasting. Shoot through those questions, but otherwise we'll speak again soon.